increase in capital gains inclusion rates has some important carve-outs for small business and entrepreneurs, but does that do enough to make sure they continue to thrive? Dan Kelly is president and CEO of the Canadian Federation of Independent Business. Dan, thanks for being with us.
Good to be with you.
And one thing I wanted to talk to you about is some of the exclusions for those small businesses. Why are some sectors not included in that?
It's a great question. We've been trying to find out from Ottawa why they would say that if you run a retail shop, you do qualify for a better tax treatment than if you run a restaurant. If you run an accounting firm, you don't qualify, but if you run and a hotel doesn't either. But meanwhile, a construction company or a manufacturing company does. We have, for the life of us, not been able to figure out, other than to say the federal government saying to us that they're paralleling something that exists in the U.S.
There is a process, obviously, as things become law. We know they're going to back time. We think they're going to back time this capital gains law to the end of June. But is it possible that in the process of it becoming a bill, that some of these changes could still happen?
It is possible, although I think time is running out. Look, this has become incredibly political, and the government is driving this really as a wedge issue. So it seems they're fairly locked and loaded. Given the language from the Deputy Prime Minister and Prime Minister himself, it doesn't seem like they're super open to amendments right now, but amendments are exactly what is needed. Otherwise, we're worried that there's going to be a pretty big broadside to Canada's SMEs.
One of the things that was achieved, and I think it's something you've been working hard at for a long time, was an increase in that lifetime exemption. How important is that to a small business person, to an entrepreneur, that they do have that lifetime exemption of $1.25 million or $2 million, depending on which one they are?
Yeah, look, there are some positives in this package, and that's one of the shames, is that we're not actually able to discuss what is appropriate for changes to capital gains. We're focused right now on the increase in the inclusion rate, which is bad on a whole bunch of levels. But there are some wins. The increase in the lifetime capital gains exemption from $1 million to 1.25, that is helpful for businesses that sell shares of their business, or for farms or fishers that sell their assets. And then there's the Canadian Entrepreneurs Incentive, another $2 million at a lower rate of inclusion. But that's the part that, as we discussed a second ago, you have to, thread the needle and be, hit about 50 different criteria before you can qualify. These are good measures, but they're masked with a giant hike for other types of capital gains that small businesses use every day, and those are important.
Of course, the argument that you'll hear is, given that spending is where it is, the revenue needed to be raised. Is there another form of tax you would have preferred to have seen, or would you like door number 2?
Well, look, I think at the start, we don't have to pick which type of punishment we want. Keeping spending under control, of course, is the better longer-term answer here. And while there is new spending in priority areas, it could have been taken from some of the giant increases in just general bureaucracy that we've seen grow over the last number of years. But yeah, we're not keen for any tax hike, especially right now. But this particular means of throwing it on small business owners, it's not going to be a tax for the uber rich. It's going to be for the middle class and those that are running the small businesses across the country. Dan, thanks so much for being with us. We appreciate your time. Anytime, Amanda.
Dan Kelly, President and CEO of the Canadian Federation of Independent Business. Time for the takeaway and playing monkey in the middle. When it comes to taxes, there's really only one word citizens want to hear, and that's lower. Right out of the gate, the federal government's change to capital gains tax is going to sound bad. The change is being billed by the feds as a way to make the wealthy pay a little more, and yet the cries of outrage about the tax are emanating not just from the very richest Canadians, but from every quarter. In part, that's because it will wind up capturing some asset sales, like a family cottage. But even then, common sense should guide our reaction. As it stands, the first $250,000 profit per year is still tax-free. That's a pretty sweet deal you don't see in the U.S., among other countries. After that, it used to be that half the remaining amount would be taxed as income. The change here is that it will be 2/3 of the remaining amount. So let's be clear, 33% of the profit is still tax-free. The difference between an inclusion rate of 50 and 66% is about an 8% increase in taxes on average across provinces. It's not nothing. But again, for perspective, we're talking about people with assets, not income, who are making a profit of more than $250,000 above and beyond the money they paid for them. It doesn't include small business owners or entrepreneurs. They have lifetime exemptions of $1.25 million and $2 million, respectively. So why all the fuss? At the end of the day, nobody likes to see taxes going up. But given that our current tax base doesn't live up to our expenditures, we run deficits at every level of government, higher taxes seem not just inevitable, but also fair, since the only other way to fund a deficit is with debt, which transfers the problem to people who aren't around yet to argue. Insisting that our governments live within their means is one part of the equation. But treating capital gains from ordinary citizens, not businesses, more like income and less like they were doing us a favor by growing their asset base is a long overdue shift in thinking. Some future government might decide that 100% of those gains should be taxed like income after a certain threshold. The argument against that is that these investments were made with dollars that have already been taxed, and that's a fair case. It's why there is a minimum amount that's tax-free. But the richer you are, the less likely it is to be true. Rich people reinvest their capital gains, making money off made money and never pay tax. Those who work for incomes alone pay tax on 100% or so of their income. My takeaway? The wealthy get wealthier because they own things. Finding ways to tax them more is only logical. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.